Hey everyone, this is Mike Kramer, Mott Capital. Today is Tuesday, October 3rd. It's around 7:15 New York time. U.S. markets are closed. It was a pretty rough day for markets overall, with really no place to hide. Whether you were long bonds or long equities, both saw pretty sharp declines today, following the JOLTS report, which came in much hotter than expected, 9.6 million versus estimates for 8.8. Last month was also revised higher. This brings us to another job data point tomorrow. Tomorrow we'll get ADP employment at 8:15 a.m. Estimates are for 150,000 versus 177,000 last month. This number has taken on additional weight because the Fed has cited it in the minutes on more than one occasion, and so it seems like they are paying attention to this and they're looking at it for evidence of whether or not the labor market is softening. And so certainly a number that comes in hotter than expected could certainly jolt the bond market quite a bit, and that could certainly reverberate through the equity market as well during the day. So this is something you're going to want to pay attention to. And then, of course, at 10 o'clock, we're going to get ISM Services Index. We're looking for the number to come in at 53.5, down from 54.5 last month. Again, this is a very big number. Prices paid index is always important. The ISM manufacturing report showed that employment improved, so we're going to want to pay attention to the services employment number as well. So you got some, big data sets coming tomorrow. And when we look at the bond market, we've seen certainly a very, very big move in bonds, with the 10-year now trading just a hair under 480. And what's interesting is that we've seen these big moves really since this whole move higher in rates began. In fact, when we look at the type of moves that we've seen in the 10-year just over the last 18 months or so, we saw an episode where the 10-year rose by 1.8%. We saw another episode where the 10-year rose by 1.8%, and now we're seeing another episode where the 10-year rises by 1.4%. So it almost seems as if we go through these phases where when the 10-year or the 30-year just break out of a range, you get these gigantic moves, and then we go through a period of consolidation. Of course, the question is going to become at some point, when do we begin to consolidate? And clearly, we had a very long period of consolidation between October of last year and, call it July of this year. And we had the same thing sort of happen, last year between June and August, and then we had another big move higher. So, we're certainly seeing the 10-year rate getting overbought, at least on an RSI basis, up to 77. But it is worth noting that it cleared 80 the last time, and currently we're just, sitting around 77.9. So there's certainly, from a RSI perspective, I mean, yes, it's overbought, but you can see, we got up to that level of 70 on a few occasions, and this is like the time that you're really seeing it move higher. And so there's the potential that the RSI could still go even higher from here, maybe above 80. And even when we look at the Bollinger Bands, you can see we're trading above the upper Bollinger Band or just within it. So again, this is certainly a condition that's overbought, but this is also being fueled by fundamentals that the market simply misjudged. And so now the market is playing catch up. And so it's quite possible that if you get a hot number tomorrow out of ADP and you get a hot number out of ISM, you could be talking about a 10-year rate that's on its way to 490, 495. Likewise, if you get a number that misses or disappoints, you could see a very sizable move lower in rates with, support at 465 and then, going back down into the 450s, which a couple of weeks ago would have sounded insane to begin with. And of course, when we look at the 30-year, it's a very similar situation with the 30-year rate, RSI approaching 81.5. It did get up to as high as 81.5 the last time as well. From an RSI perspective, again, overbought. So you're in a situation where you could see very big drawdowns if you get weak data. If the data continues to come in hot and there's continuing signs that, that the Fed is going to continue to be higher for longer and the data is not showing any signs of softening, then you have to think rates can continue to go higher. One reason why that may be the case is because when you look at the 10 and the 2-year, that spread has just really exploded the last couple of days. You can see we went from a negative 110 basis points or so at the very low to now sitting at negative 36 basis points. Basically, back on par with where we were during the SVB and spring episode. And, again, if you're going to see a period of time where the 10-year is going to trade at par or parity with the 2-year, then fundamentally speaking, the 10-year could rise another 35 basis points just from where it is right now, depending upon, how this data continues to come in. Because at this point, it is the 10-year rising to the 2. It is not the 2 falling to the 10. And this is really important because, many people associate a steepening yield curve with the 2-year falling to the 10, and that's just not what's happening because the 2-year has been very well anchored around this 515 area. And the reason we care about this spread on the 10-year is on the 10-2 is basically when we take the S&P 500, when you just overlay that with the 10-2 spread, you can see that basically since March, all we've been doing is trading with that spread. And so the higher that spread goes, the more likely it is that the S&P 500 and the equity market in general is going to continue to sell off. And so this is really, again, key here because the S&P 500, let's face facts, it's closing in on 4,200 right now. This is a big level of significance because a break of 4,200 is going to extinguish the 20% gain off the lows, which is going to be a big psychological blow because you're no longer in a bull market from that standpoint. Number two, you have the 200-day moving average floating around here at 4,200. You have this big level of horizontal resistance at 4,200. Likewise, you can see the diamond reversal pattern has been broken. You've also broken this long-term uptrend. Now, in terms of what, how the market sort of maneuvers tomorrow, again, I think a lot of that's going to be determined by, rates in general. If you start seeing rates pulling back and that spread widening some and that spread moving lower again back towards, negative 100, let's say, in that direction, you could see the equity market rally and at least, take out this high certainly at 42.40 and then retest this trend line at 42.48. That's certainly in the cards. But again, if you get a number that comes in hotter and you start seeing rates on the long end of the curve continue to move higher and that spread continues to move closer towards 0%, and I think you're going to see the S&P 500 test that 200-day moving average at 4,200, if not even try to break it again, because from a technical perspective, once you get past 4,200, the next major level of support really doesn't come until 4,100, and that's something worth being aware of. When you look at the same thing on the NASDAQ, essentially you have, the October lows broken, you have what looks like a diamond reversal pattern, you have what also looks like a head and shoulders pattern with the neckline that the index just can't hold. We broke the neckline, we got back above it, came back below it. You have this big long trend line, got back up to it on a couple of occasions, tested it, failed, couldn't get through it. So this 14,600 region, again, very important. If you get, it's all going to depend on the data, I think, at this point, because certainly there's room for the NASDAQ to rally pretty big here, 14,632. And then, of course, you got, this room up here to 14,672, which is this level of support and resistance that goes back now for a couple of weeks and is part of the neckline on the NASDAQ. And, when you look at the Dow, again, another sort of index that we've talked about on numerous occasions, the Dow just continues to, plummet. It's now broken its 200-day moving average